March Madness is a whole lot of fun if you're a basketball fan. March Market Madness is a whole nother thing. And the market has been a little crazy lately. So let's pull up our indicators. Let's look at the market, short term, long term, see if we can pull together a big picture about what's going on and what's likely to come in the future. With that, I'm Bruce Frazier, your host. Welcome to Power Charting. Let's get started. I showed you this chart 2 weeks ago when we last got together. And this was a beautiful accumulation structure for interest rates, 10-year US Treasury yields. So at that time, we took that count and thought that it was backing up to an important resistance area. Well, sure enough, it took off out of there. And you can see that since that time, we can see that we can see here that there's been this incredible run up to the first count objective range, which is this area A here. Well, in fact, we have gone to the midpoint of this count area, and we've gone there very quickly, straight up. So the yield now is 173, and when this whole show started, they were around 0.90. So interest rates are rising quickly. Let's now look at US Treasury 10-year prices. And here you can see a big distribution structure, which we showed before. Beautiful reaccumulation count here, counted right up into the highs. Distribution formed then after a climax. We took this count. Well, now at the time we first showed this, we were still not in the objective range. Well, now we are. So 131.47, which is right at this point here. So we're smack in the middle of this. Doesn't mean that the decline in prices is yet done. There may be a continuation of this, but I would suspect that we'll get some kind of a consolidation in here where we'll pause, possibly form redistribution for another move down to the lower price objective range. So stay tuned and we will watch for that. Now here, this is the 10-year US Treasury yield again. This is 1983 to 1990. What we're really interested in is this area here. I've shown you this chart before, but it continues to be relevant to us. So let's just keep an eye on it. And you can see an incredible rate of change jump on the 13-week rate of change here and here. This was the final high for rates, which was over 10%. Well, look here, as we were running up into the final highs, August and October of 87, we made a high, we tested the high in October, and then we had the horrific crash of 1987, which was really an incredible event. And so this decline is not what I'm necessarily suggesting or even believe that we could have that here, but I am going to make the case that rapidly rising interest rates can unnerve a stock market. That, I believe, is contributing to why the market is stalled here. So keeping that in mind, let's move on. Let's see, is there anything else we want to talk about here? Just this is a really great accumulation area right here, and look at the family resemblance. Here's the current environment. 2020 accumulation area comes out. This is the point and figure chart we just looked at 2 slides ago. And so that point and figure chart of yields, well, here's the run up. Here's the current level of 1.738, I believe that is. And so you can see it running up at a very rapid rate. And even when the Fed said that they were going to continue to have accommodation and made dovish comments, it actually caused rates to rise faster. So this is an interesting sort of convoluted turn of events for the bond market. Now, you can see as in 87, the market has been just steadily marching higher here, continues to run up. This is the S&P and make new highs. And the rate of change here is a whopping 82%. So this is an incredible run, but like we said before, interest rates are at a much lower level, but valuations in stocks are at a higher level than they were back in 87. So it's kind of a mixed bag here, but I think that the key is how quickly do rates go up? And so this, I believe, is starting to be an influence on the stock market and stock valuations. Okay, so I will be right back. A very exciting announcement for you is the Best of Wyckoff Conference 2021 is coming up, and you are going to want to be there. And here's the good news. It's absolutely free. 4 hours of just pure Wyckoff, produced and presented by exceptional Wyckoff educators and Wyckoff thinkers. And this is how to sign up for this great event. First, go to wyckoffanalytics.com, wyckoffanalytics.com, and at the top of the page in this red banner, you'll see register here, where you can just go right in and register for the conference. This is, I believe, the 7th conference that we've done. Then, if you want to learn more about the speakers and about the events of the day, it's going to be a 4-hour conference. You go to live education here and go to the Best of Wyckoff 2021 online conference. And here is the landing page for that. You can register right on this page. And then here are the speakers and when they speak, and also their topics. And this is going to be just a great, great day. And I will be there and doing a couple of different things with Ramon and on a panel discussion. I can hardly wait. It's going to be tons of fun. So please sign up. Now, let me tell you the easy way to sign up. I'm going to have a link on the YouTube page underneath the description for this video episode. You can go right down there, click on that, and go in and sign up for the event. And I think that there's going to be lots of room for people, but it could fill up. I think it did last year. Let's turn to some longer term charts here that are, I think, very illuminating. This chart I find particularly interesting. This is the triple Qs, Nasdaq 100 ETF. And as you recall, when you draw a trend line, do trend line analysis, that we draw two adjacent lows. We will draw the trend line, if we can, off of those two adjacent lows with a parallel on the intervening high. It's exactly what we've done here. Look at this, early 2016, the trend stride was established extremely early in the uptrend. And look at how, even though there's been attempts to trade down and out of the channel, it's continued to ride along and rise along the stride here, including with the big COVID decline and then the very large run up. So you can see here two important trend lines. There's also another one here, but this is the trend channel. And after jumping out and running out of this area into 2021, the triple Qs are now pulling back and touching the top of the blue channel, and also are in the range of the red trend line. And so this is a very important area to find support for the triple Qs on the run up that's been taking place since 2016. If it starts to break down into the channel, there is the risk of going to this moving average. This is a 39-week moving average. And then also going down to what we call the demand line, which is the lower trend line in the channel. And so that's quite a ways down from here. Also, do notice that the relative strength is already starting to flatten out and turn down for the triple Qs. So after a very, very long, as far back as we have history on this chart, you have an upward stride, upward trend for the relative strength that now is at risk of breaking down out of this upward moving average and also this trading range. Very interesting, and we'll keep an eye out for that. Here is another trend line. This is the Nasdaq comp. Very long term, goes back to 2010, and this just really illustrates the bull market for growth that's occurred since 2010. We've had a decade of growth stock leadership, and you can really see that here because the top chart is the actual Nasdaq comp, and this trend line, look at on these two early points here, we draw a parallel. It touches here, touches many times on the way up. Then we draw the parallel on this low here, and you can see the beautiful touches in the channel. Comes out of the channel temporarily and goes back in. That's a sign of a really useful channel construction. So now we are up and out, and so it is accelerated up out of the channel, the comp, and we are watching it. This is through today. We are watching it for whether or not it's going to attempt to come back to the upper channel, the reverse use of trend lines channel line here. And below, this is the relative strength of the Nasdaq comp to the S&P 500. And you can see the explosive move in 2020 for the Nasdaq comp, the growth shares, and how they just went into massive dominant leadership. They were been leading all the way through the decade, but then it's as though they went into a huge climactic surge that came at the end. And we've talked about how growth often comes to the end of its secular move with a big boom in IPO shares. And that's exactly what we've had here recently. So now see the turn in the relative strength. The relative strength is now starting to really turn off of an inverted V top in the relative strength. And this is put it back to its long-term moving average. We're going to want to watch this very closely because this is what happened back in 99, 2000, inverted V top. And so the relative strength here is going to be very important to watch, in addition to watching this trend and whether or not the Nasdaq comp can be weak down to the trend line and into the channel. And we will just keep an eye on it together as time goes on here. This is a chart of yearly bars. No, these are the weekly bars. I have a yearly one too. These are weekly bars of the, no, I take that back. This is these are yearly bars of the S&P 500, goes back to 1924. The first anchor point for our trend line is 1942 during the war. The second anchor point is actually 1974, very nasty bear market. And so those establish the upward stride of the advance. You can see how well the stride has worked for the S&P of this trend channel. We have drawn over the tops of these yearly ranges the overbought line, which is the parallel line to the demand line. And you had one attempt to come up and out of the channel. It came in, rode along. Again, each one of these is a year. It got almost back in the Great Recession to the bottom of the channel, not quite. but now look what's happened. We had an advance that has taken it right back up to the top of the channel. You can see that last year, 2020, was a very interesting year. It was an outside range year, lower low, higher high, and closed right on the upper channel. And look what's happening now. We have a very, very tight range here in this area, and it's just hovering here. I do believe that we're going to have a range bound market for the first half of 2021, and pretty much that's what things are shaping up to look like, but we'll keep an eye on that. But I do think that there's a really good chance, especially with that blow off in the Nasdaq comp relative strength and the reversal, that we could be looking at a trading range, probably a wide and volatile trading range to boot. This is the Vanguard Value ETF. I started looking at this really last fall, around September. You could see that this was the big collapse of value compared to growth. This is a ratio, this is a relative strength. When the line is going down, that means that growth as measured by the triple Qs or the Nasdaq 100 is dominant. This was the climactic run in growth that occurred in 2020 into the middle of the year. Then a base was made. We've looked at this chart in the past. I've just brought it up to date so that you can see it, but look at how it rode along the bottom of this channel. This is a reverse use of trend lines here. These are the 2 points we've drawn on, parallel from here and a parallel here. And now we're seeing an attempt to go up to the upper channel line and possibly even to the one beyond it. So here is a reversal. An emphasis of value over growth has occurred starting last summer. So, and we've been talking about it pretty much ever since. This is the small cap Russell 2000, which is very much a value index in a ratio, relative strength ratio to the triple Qs at Nasdaq 100. I'm going to just let you screen capture this if you'd like. This is brought up to date, but you can see how the value stocks are just tearing it up compared to these large cap growth names like the FANG stocks and others. And here we go. Stocks have been going up, but what's been going up fastest? This, and we documented it at the time after the spring was formed, that this is all rotation. We are in the process of creating rotation, and our Wyckoff techniques did a beautiful job of identifying that for us. And then here you can see, this is a point and figure chart, same concept as before. This is a ratio. You can do point and figure on anything. We just did it on interest rates. Here's a point and figure on the S&P 500 value ETF in a ratio of relative strength to the S&P 500 growth ETF. And I've taken a count across here, and the count goes from here over to here, right across here. This count, which is on the 60 line, 60.40 line, counts up to a count of 9280. And I'm going to show you what that means here. But this is a beautiful accumulation structure, has a nice count, a beautiful backup, shallow backup that now looks as though it's pivoting back into an upward trend again. And so this again is the idea that value is going to continue to have dominance. So now I told you that it was 92.8 was our target. Here's our little point and figure area. And as you probably were saying to yourself, well, I think that count could be even bigger than that. Absolutely true. And a good catch on your part. The count that I have, because I always start with a more conservative count, 9280, well, that's right here. This area right there. And so that's how much and how long value could outperform growth here going into the future. And so we're again focused on the notion that value is going to lead and dominate for the foreseeable future, and we will continue to document this as we go. And this is just the value to triple Qs if you want to see that base. We just looked at the IWM to triple Qs. Here's the VTV, and you can play with that if you like. Now let's turn our attention to the shorter term time horizon. This is the S&P 500 2-hour chart. Big trend channel. You can see that this channel has actually been going on for quite some time. It's not even all on the page. We had a big break. Recall that we had a video where we talked about at the time of pushing up against these highs that there was a divergence taking place in the New York advanced decline data. So this is advancers minus decliners, 5-period moving average. And this divergence was a big warning to us. Look at the level that this was at the time that we went up, became overbought over the channel, which is a classic signal, and then started to turn down, and it resulted in this big decline. Well, since then, actually the S&P 500 has gone up and pushed up to a minor new high, and that new high is a rally from out of the channel up to the channel from below. So now the demand line in the channel, which I always draw the demand line as a solid line, the demand line is now acting as resistance for the S&P 500. Now, two things are going on here. This is a classic overbought condition right here, but also look at the divergent characteristic in the AD data. The AD data is just falling and continues to weaken on a rally of this magnitude. This is a rather rare event, but you can see in the early part of the rally, this line was going up nicely. And for you traders out there, this is a good environment to trade from the long side, is when you have the AD data rising like this and also prices rising. When divergences show up as they did across here, that's when you have to start to become concerned, and you can actually see a small topping process here taking place over these last number of trading days. And then today, a very sharp decline in the S&P and other indexes that we will look at here in a minute. Just a quick look at GDX. This is gold, and you will see here we've looked at this channel before. We've talked about it in the Wyckoff market discussions in the last number of weeks, but here are the two anchor points for our trend line. This is the reverse use of trend lines in a downtrend. This is the channel, which is drawn off that peak there. Look how beautifully this has worked. Created great opportunities to be able to trade at the bottoms and the tops of this channel as it's been declining. We pointed out at the time that it was falling back through the channel here, and that we would be looking for an attempt to rally up into the channel again and possibly to the top of it. That seems to be what's happening. So we will watch GDX and gold for some renewed strength going forward, and see whether or not it's possible that there might be the early stages of accumulation in here somewhere. Now, this is the Nasdaq comp, and this is 2-hour data, and the Nasdaq advanced decline data, net advanced decline, 5 period moving average. So again, looking at this, you'll see that what's really interesting is that we have what appears to have the attributes of distribution. One of the things that's really important in my way of thinking is when distribution, you have to have a sign of weakness. And the sign of weakness is a breakdown through key support levels, even if there is an attempt to rally up after that. And this rally's been pretty good. The thing about this rally is that this could be a last point of supply, and we're seeing an attempt to break down. Well, look what's happening to the net AD data 5-period moving average is that it started off having a very, very good rally of advancers over decliners, meaning that you could trade this from the long side, but then you start to get divergent behavior here, and look at the weakness that's come in as there's been an attempt to go up. The rate of advance is slowed. The up thrusts are narrowing on the way up, and this is looking like a very small distribution area in a larger distribution area. So this is a warning to us to be super careful, especially as a trader trading from the long side. And we can see that it was a very large down bar today that actually took out key support levels on that smaller time frame. So we're going to keep a very close eye on that. And this is the Treasury yield chart that we just looked at, so we don't need to look at that again. This is interesting. This is the Van X Vectors Semiconductor ETF SMH. Beautiful upward channel since the middle of last year, became overbought and threw over twice here at the top of the channel, just as the market had. Look at this breakdown out of the channel that came very quickly. Now an attempt to rally up to the underside of the channel. I've taken a point and figure count of this area, just a swing trading point and figure count. And this count takes us to 196 to 180. So there is the potential to decline down to this support area here. And if we're in a big trading range, then we would expect that that trading range is going to have that kind of volatility in it. And here is the point figure count. One box reversal, and this is 4-point scale, and I've just counted across from here to here. And this count could become bigger. This is the Nasdaq 100 index. You can see the top that we looked at on a shorter term basis in the Nasdaq comp, but here you can see this distributional quality that, you know, potentially could take us down to the support area here. But really what I want to show you is how this stocks above their 50-day moving average has really started to trend off. And so the thing that we would worry about here is this continuing to go lower. As long as these stay make higher lows throughout, this is going to be probably okay. We'll may have more weakness, some testing down here, but again, the idea of a big trading range. And with that, I'm going to say goodbye. See you next week. Thank you so much for being here.